The big beautiful bill signed into law on July 4th of 2025. In this video, I'm going to go over the top 5 aspects of this bill that affect the vast majority of taxpayers here in the United States. The first is that the tax brackets that were created in the Tax Cuts and Jobs Act of 2017 have been made permanent. On top of that, there's going to be an inflation adjustment going forward on the size of those brackets as well. Another key aspect that was made permanent is the qualified business income deduction. This was created in the Tax Cuts and Jobs Act and was set to sunset and go away at the end of 2025. This is a very key deduction item for business owners within certain income limits. The standard deduction was also made permanent. So for those who are married filing jointly, in 2025, the standard deduction is $31,500. For those who are single filers, it's $15,750. There's a couple of nuggets inside here that apply to those over the age of 65. So the Tax Cuts and Jobs Act of 2017 created for those over the age of 65 an additional deduction to tack on to their standard deduction. So for married filing jointly, each spouse could have an additional deduction of $1,600 for a total of $3,200 to tack on to their standard deduction. So for those couples that met those requirements, their standard deduction was actually $34,700. The big beautiful bill includes an additional deduction on top of that. So in my opinion, this is a way of Congress addressing the issue of taxing Social Security. So this bill does not eliminate taxation on Social Security, but for those over the age of 65, it does give them a much higher deduction within certain limits. For those with taxable income that's less than $150,000 for married filing jointly and less than $75,000 for those who are filing single, they're able to deduct up to $6,000 per person. So for a married couple, they've got a $31,500 standard deduction. They have another $3,200 worth of the age 65 additional deduction. And as a result of the big beautiful bill, so long as their taxable income is below $150,000, they get another $12,000 to put on top of those other deductions. So that gets them to a point where their standard deduction can be $46,700. This is important because it's going to lead to the next aspect, which is state and local taxes. One of the biggest bones of contention with the Tax Cuts and Jobs Act of 2017 was that state and local taxes were capped at $10,000. So for those that were in relatively high tax states, they lost a large portion of what they were able to deduct. This bill addresses that by lifting the cap from $10,000 to $40,000. But there are some caveats with respect to income. So for those with incomes in excess of $500,000, they are going to be subject to the old cap of $10,000. They're not going to be able to get to that $40,000. The other key component to this is that state and local taxes have always been an itemized deduction. So a taxpayer has to choose whether they're going to itemize or whether they're going to take the standard deduction. And for my prior example, married filing jointly, both over the age of 65, has a deduction of $46,700. So even if they're paying $40,000+ in state and local taxes, that's not going to equal what their typical standard deduction is going to look like if they have no other deductions for that year. Now, this additional $6,000 deduction is not permanent. It's only for tax years 2025 to 2028. There are a couple of interesting additional deductions that this bill includes. Is the auto interest deduction. This one's an interesting one simply because it's an itemized deduction, but it can be combined with your standard deduction, but it has to follow some rules. The first and most important rule is that the car has to have its final assembly here in the US. So it's obviously going to favor the purchase of quote unquote American-made automobiles. The interest is limited to $10,000. But this, like I said, could be tacked onto your standard deduction. The last of the 5 applies to charitable deductions. Again, these are itemized deductions, but to certain limits, this can be combined with standard deductions. This doesn't start until 2026. For those who are charitably inclined, they can deduct up to $2,000 for married filing jointly and $1,000 for single filers on top of their standard deduction. Ordinarily, charitable donations need to be itemized. This allows for those who are charitably inclined to get a tax deduction for a portion, if not all, of what it is that they make donations for. So I think the biggest takeaways from the big beautiful bill is that it's going to keep tax rates relatively low for the vast majority of tax filers. It's going to offer those over the age of 65 some opportunities to be able to have a higher amount of deductions and potentially lower their taxes as well as being able to reward those who are charitably inclined but may not be giving large sums of money every single year, because with the passage of the Tax Cuts and Jobs Act, some of the smaller donations were kind of swallowed up by the standard deduction. So this allows them to be able to get a bit more in the way of some tax strategy for what it is that they're naturally giving anyway.